There's a concept that every investor knows and almost no employee thinks about when it comes to the company that they work for, and it's called valuation multiple. And understanding it, and I mean really understanding it, might be the most important piece of a financial self-awareness that you can develop about the company that you're betting your career on, especially right now. Let's start with the foundation, the acronym EBITDA, EBITDA. I know some of you know it, but for those that don't, it's earnings before interest, taxes, depreciation, and amortizations. Sounds like an accounting term, and it is, but here's what it actually means in plain language. It's really how much cash a business generates from its core operations before the accountants and the banks get involved. It's really the closest thing to getting a clean read on what the business actually earns. Now, when investors value a company, they don't just look at the EBITDA. We're going to call it earnings from here on. They don't just look at the earnings in isolation. They look at it relative to what the market is pricing the business at. That ratio, enterprise value divided by the earnings, is the multiple. See, enterprise value is the total implied value of a business, equity plus debt minus cash. Think of it like this. That's what the math says the whole company is worth on any given day. Not necessarily what a buyer is willing to write a check for, but what the market is implying based on how investors are pricing the stock. So if a company generates $10 million in earnings and the market price is worth $100 million in enterprise value, that's a 10x multiple. It's a simple concept, but watch what happens with that number over time, because markets re-rate industries. And when an industry gets re-rated upward, the companies inside it, they look like they're creating enormous value, even when the underlying business hasn't actually changed. Software is a textbook example of this. From 2015 to 2019, software companies traded at roughly 15 to 20 times earnings. Then the interest rates went down to zero, capital flooded in, and investors decided recurring revenue software businesses deserved a premium unlike anything the market had ever seen before. And by 2021, median software EBITDA, or earnings, those multiples, they hit like 26 times. Some segments reach even 40 times, or nearly 40 times, somewhere in that ballpark. Think about what that means. A company doing $10 million in earnings, the market was implying that the business was actually worth $350 to $400 million. Not necessarily because the buyer was writing that check. That's just what the math said based on what investors are paying for that stock. Same business, same earnings, just a different number that the market decided to put on it. That's called a re-rating. And then the interest rates went up in 2022. And the re-rating went the other direction very quickly. By 2023 and 24, software earnings multiples, they compressed back down to 17 to 22 times range. Same companies, same earnings, and same products. The multiple just reset. And roughly $230 million in implied value evaporated out of that same $10 million business. Not because the business got worse, it's just because the conditions that inflated the multiple had changed. That was wave one. Rate-driven compression is what that was. Painful but understandable. The kind of thing that markets have recovered from before. However, in comes wave two. It's different. And it's happening right now. So if you look at the end of 2025 and right into 26, just over the last month or two, software stocks took a huge hit. And this time, the rates had nothing to do with it. It had nothing to do with interest. The software sector ETF that tracks these companies right now is in like a 23% drawdown. That means it's down 23% from its peak since January. That's roughly $2 trillion in implied market value gone, wiped out in just a matter of weeks. This compression is not cyclical, it's actually structural. So the market is asking a question here that it's never really asked before about software companies. It's asking, is this product being replaced by AI, or is it doing the replacing? The companies building AI infrastructure, data systems, the platforms that AI runs on, those are holding or expanding their multiples. But legacy horizontal software like workflow tools, CRMs, document automations, customer service platforms, the market is repricing the durability of those business models all in real time. Why? Because if an AI agent can do the work that used to require 10 seats of your software, the revenue model that justified 30 times multiple just doesn't hold up anymore. So here's why this matters beyond just investing. Because if you work at a software company or hold equity in one, or evaluating a career to move into one, that multiple that businesses trade at is going to tell you something critical about how the market views that company's future. And when the multiple compresses, especially structural, the implied value of everything inside that company moves with it. So you don't need to be a financial guru here to understand this. You just need to know what questions to ask. And by the way, this is not just about software companies. This is about re-ratings. It's about understanding PE multiples. Like, what is the market pricing this business at? And what would happen to that number if the conditions that created it actually changed? So right now, for a lot of software companies, the question has a real answer. And it's one worth knowing because that answer, it applies to other industries, and it's having real effect on careers, families, and livelihoods. And here's how I think about it. I'm going to cap it off with this. Never mind the software companies. That's just a data point. It's a reference point rather than a data point. Even though there's data in there, it's more like what happened in this industry, in this sector. Well, what's happening in this sector and what's happening in this sector. So if we're looking at our jobs, and let's say that we're senior leaders in some of these companies in certain sectors, I think it's a good time to just take a look and say, what is happening in this sector? What is my potential to see a re-rating? How do we stack up with AI? How are we embracing it? How are we utilizing it or not utilizing it? There's a lot of different factors that structurally have to be determined at this point. This is not financial advice. It's more like an understanding of what's happening to our company can help us to make better decisions, or it can help us to ask better questions. That's probably even the better thing. Because to really understand where we're going in our careers or, our investments, we've got to ask these hard questions. That what is happening in this sector? How stable is it? How durable is it before we're going to keep going, or whether we're going to pivot? And then if we're going to pivot, how? What structures are in place to allow us to pivot? These are the hard questions, but they're the essential questions.